Welcome to PhillipCapital's Weekly Market Watch. China is undoubtedly becoming increasingly important to the world economy. So how will markets react to the Chinese government's action to tighten the controls on credit growth again? Hilary Ho from Phillip Securities Unit Trust Department shares her views with us today. In our last interview, you mentioned that the Chinese authorities have heightened their efforts to rein in soaring credit growth. Recently, it seems as if they have tightened the controls again. So what is the latest measure implemented?
Okay, of late, we saw a continuation of efforts to rein in soaring credit growth. The China Banking Regulatory Commission told the commercial lenders to restrict new lending they provide to local governments' financing arms. In addition, they have ordered banks to inspect their existing loans to companies used by local governments to raise funds and to stop lending to those projects that are backed only by expected fiscal revenues. So clearly, in the eyes of the authorities, the balance of risks has shifted in China away from an economic downturn and more towards higher inflation, overcapacity, and also potentially destabilizing speculative behavior.
Do you think more tightening will come?
Okay, we are of the view that more tightening will come. This is because we believe the authorities are now positive on the country's economic recovery, as economic data such as the Purchasing Managers Index, the industrial productions, is generally pointing to continued expansion. In addition, with the aim to limit the amount of new loans in 2010 to just renminbi 7.5 trillion, government intervention is actually essential. Discipline can only be instilled in banks with policy actions so as to maintain a reasonable pace of credit growth.
Will these measures potentially stifle growth in China in 2010?
We do not think that growth will be stifled in 2010. This is because although the government's target is to rein in credit growth to just renminbi 7.5 trillion, this amount is still considerably large in China's monetary history. In fact, this is the second largest amount after last year's renminbi 9.6 trillion. Therefore, the amount should still be sufficient to support growth in the country.
How do you see the Chinese market moving in the short run?
Okay, in the short run, we expect markets to respond negatively to the initial headwinds of policy tightening. However, it's interesting to note that the Shanghai Composite Index did not turn south when the latest measure was announced. However, despite so, we do not think the news has been fully priced in. Okay, although we expect volatility in the short run, we still believe in the growth story in China. The Shanghai Composite Index is now trading at a PE of 32 times. During the peak of the rally in 2007, the index was trading at 51 times. As of 25th of February, the index stands at 3,060 points. And from a technical perspective, the immediate support for this index is at 2,890 points, and the immediate resistance is at 3,144 points.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.